You're listening to the Economics and Country Risk podcast from S&P Global Market Intelligence. In each episode, our experts will provide you with the where, how, and when to make decisions that transform your business.
In this episode, our experts provide regional insights into construction markets around the globe. You will hear from our global construction team at S&P Global Market Intelligence, Jeannine Cataldi, Associate Director, Amandeep Bahra, Senior Economist, Sibiya, Senior Economist, and Tyan Li, Senior Economist. And now over to Jeannine.
Good morning, good afternoon, and good evening. My name is Jeannine Cataldi, and we're going to be looking at some of the key themes in 2024 across the different regions. And now I'm going to turn it to Tyan Li, who's going to take us through the outlook and some key themes for the Asia-Pacific region.
Thanks, Jeannine. The near-term economic outlook for the Asia-Pacific region generally remains positive, supported by recovering market demand in emerging markets and India, and a rebound in the tourism industry and a gradual easing of inflationary pressures. Headline inflation is showing signs of moderation in the region, and we may see an earlier than expected rate cut in Asia-Pacific. But we are still seeing some important headwinds, including the global economic uncertainty and a slowdown in mainland China's economy. And despite these challenges, construction spending in Asia-Pacific is expected to experience a healthy growth. Next, we move on to the key themes for Asia-Pacific. We look at mainland China's construction sector. Given the weak property market, mainland China's construction growth will still be lifted by infrastructure sector, and the infrastructure investment is expected to stay robust under the 1 trillion yuan water-oriented sovereign bond, which was issued in 2023 but will be used in this year. And we expect a broad fiscal spending in this year, covering the budgeted spending. Sovereign bond and local government special bond will be expanded from 2023. However, compared with comprehensive fiscal easing, the limited expansion of spending will concentrate on the most fragile and demanded sectors. Meanwhile, the real estate market is still stuck in a downtrend. In response, the government has further shifted its housing market policy to the supportive side, including reducing mortgage interest rates and provide financial support to developers to complete unfinished pre-sold housing projects. We expect the housing market to remain weak in this year. And across the Asia-Pacific, we can see two different scenarios when it comes to residential market. First, Hong Kong. The housing market continues to face challenges as buyers are cautious amid rising interest rate and the complex external environment. The policy relaxation had no impact on the housing market, and to drive purchases, developers started offering double-digit price discount to clear inventory. The transaction volume for residential dwellings peaked in March, but the rebound was weak and short-lived. The slowdown in sales has also discouraged developers from buying new land. The number of loans approved in 2023 has shown a downward trend. Weak demand remains the main issue in the Hong Kong residential market. We are not expecting a significant rebound in home prices due to the government plans to build subsidized sale flats in the next 5 years, which will dampen the demand in the private housing market. So we believe that the weakening of property market will continue in the near term, with house prices expected to fall in 2024. And in contrast, Australia's housing market continues to defy expectations. Since the property market bottomed out in early 2023, the property prices have been rising ever since, despite the aggressive rate hikes from the Reserve Bank of Australia. Growth has been driven by record levels of net overseas migration and tight rental markets. But shrinking home building approvals and rising material costs are constraining housing supply. The continued fall of building approvals, alongside with the elevated population growth, exert upward pressure on both house prices and rents. And also an expected cut in interest rate in this year could feed into improved consumer sentiment, which we're likely to see a spur in activity and create another house price upswing. And last but not least, another noticeable trend is the growing of e-commerce and diversification away from mainland China boosted the industrial sector. A growing number of companies are looking to move their operation due to a number of reasons, including increasing labor costs and the trade tension between the US and mainland China. Some of the countries that are benefiting from the shift include Vietnam, India, and Malaysia. For example, the Indian government has taken a number of steps to encourage foreign investment into the country, including reducing taxes and regulations on businesses, investing in infrastructure such as roads, ports, and airports, and some investor-friendly policies. And furthermore, Southeast Asian economies like Malaysia, Thailand, and Vietnam have multiple free trade agreements signed. And as a result, we expect to see an upward trajectory path for the industrial sector in Asia Pacific in the near term. The industrial sector is expected to witness the highest construction spending in the non-residential segment at $780 billion in this year. And that's all for Asia Pacific. I'll pass to Neil to talk about Middle East and Africa.
Thank you, Shing. I will start off with the key themes for 2024 in the Middle East and Africa region. The MENA region experienced a large, sharp real GDP decline or slowdown in 2023, which is attributable to falling oil output in the GCC countries. Oil production cuts are anticipated to last until 2025, constraining growth in the region. The ongoing attacks in the Red Sea add a layer of potential downside risk, impacting MENA oil exporters. Looking at the non-oil sector growth, it continues to be solid. However, it likely weakened at the end of 2023 and will continue to weaken in the first half of 2024. The Israel-Hamas war is expected to continue, and it will probably last through most of 2024. Looking at Egypt, its external liquidity crisis remains unresolved, although there are new reforms that are expected there, as firms subsequently facing both rapid input cost inflation, and a pullback in customer spending. Given the tense regional environment and Egypt's important role for regional geopolitical stability, our analysts expect enlarged IMF financing that will likely trigger further support from regional allies and the EU. Turning to the sub-Saharan Africa region, there are some positive factors impacting regional economic activity in 2024. These include some structural changes such as improved electricity supply in South Africa, exchange rate and fuel subsidy reforms in Nigeria, and some startup large projects like the liquefied natural gas production in Senegal. These structural reforms or changes, combined with lower inflation and interest rates, are projected to support expansion in 2024 in the region. On the downside of things, debt vulnerabilities remain in the region. Borrowing and debt accumulation levels by the sub-Saharan African countries have become unsustainably high, leading to several defaults on external debts by countries like Ghana, while in Kenya and Nigeria, debt stress is currently severe and will remain so during 2024 for both external and domestic liabilities. Although interest rates may fall in 2024, countries experiencing distressed debt metrics face reduced capital and financial inflows and limited access to global financial markets in 2024, which leaves them with their external liquidity under significant pressure. This increases risks of contract revision for domestic state projects, potential shortages of imported materials, as well as essential imports, and economically driven popular protests. Another thing to look out for is South Africa's elections. Usually elections are associated with uncertainty, and recent polls show that the ruling party may receive a declining share of votes in this year's election. Another also downside factor to look at is the El Nino weather condition risks, where food supply chain disruptions and potentially higher food inflation for longer than we currently forecast. Kenya has a host of projects, some already underway, and a bulk of which are transport projects. Construction in Senegal will remain boosted by the Dakar Sports City project that is being developed in preparation for the 2026 Youth Olympic Games. Additionally, the startup large-scale projects such as the LNG production will boost Senegal's total construction. South Africa is expected to be the least performing market in 2023. Although it's still in contractionary phase, it saw the largest upward revision in this forecast round compared to a previous one, as official data came in stronger than expected, and this prompted an overall upward revision in construction growth. It is expected that South Africa will rebound in 2024 in the Middle East and Africa region, owing to diversification efforts in Saudi Arabia and stronger investment, particularly in energy, including renewable energy and developmental projects in sub-Saharan Africa. Infrastructure is now projected to grow in 2023 and 2024. Transport will likely support growth in 2023 and then will be overtaken by the water and sewer subsegment in 2024. Construction spending in the region will, over the next 5 years, be ranked the fastest growing construction region in the world during this period. With that, I will pass it over to my colleague Amandeep to take you through Western Europe and Eastern Europe.
Thank you, Neo. So I'll go through the outlook for Western and Eastern Europe as well as the key themes that we expect over the year. Starting off with the Western Europe. If we take a look at the ECB's latest bank lending survey, it shows that lending conditions to firms in the commercial real estate, construction, and residential sectors tightened significantly in the second half of last year, and Euro area banks expect a further tightening of lending conditions in the first half of this year, which does suggest a further hit to construction demand and activity across the Eurozone. Construction firms will continue to face challenges from high construction costs, even though material prices have fallen down significantly in recent months, as well as issues regarding availability of skills. Some of these factors, especially macro factors, have already affected the new pipeline of new work, as we've seen in the recent construction PMI surveys compiled by S&P Global. The Eurozone PMI survey, which covers Germany, Italy, and France, as well as a separate UK construction PMI survey, showed that new orders continued to decline towards the end of last year. Building permits for both residential and non-residential declined in the first 3 quarters of last year across the Eurozone. Similarly, in the UK, data for new orders have been pretty much grim, and they declined in the first 3 quarters of last year, with declines across almost all sectors of construction in the UK. So given the weakness in these forward-looking indicators of activity does suggest that the downturn in Western Europe is far from over. Having said that, central banks in the region are expected to begin rate cutting from mid this year, especially the ECB and the Bank of England, and this should support a revival in demand and activity towards the end of the year, but more so in 2025. There are growing risks on the horizon, particularly relating to political uncertainty surrounding the upcoming elections, as well as the prospect of renewed cost pressures, which may be exacerbated by the disruption to shipping in the Red Sea as well. In terms of our construction forecasts at a market level, we expect construction spending to decline across 10 Western European countries this year, and that includes some of the major markets, including UK, Germany, France, and Italy. Also, all Nordic countries are expected to see a decline this year, with Sweden leading the way with the sharpest decline of around 6%. Elsewhere, Spain, Greece, Portugal will see a continued expansion in the near term, and that's largely due to EU funds, particularly from the EU's Recovery and Resilience Facility. Turkey, additionally, will benefit from reconstruction efforts following massive earthquakes last year. At a segment level, residential will remain the largest drag on overall industry growth this year. That reflects some of the lagged effects of higher borrowing costs, tighter credit conditions, as well as a deterioration in some of the forward-looking indicators of activity, such as building permits, new orders. Also, housing starts have fallen away sharply in recent quarters across some of the key markets. In terms of non-residential structures, again, the segment will feel the pinch from some of the macro headwinds as well as political uncertainty. Meanwhile, infrastructure will remain a bright spot in the near term. However, we have lowered our growth forecast again. That's largely due to delays and cancellation to major transport projects, particularly roads and rail in the UK, as well as the impact of any political uncertainty and physical tightening. Moving on to Eastern Europe. Unlike Western Europe, the outlook in this region is going to be relatively positive. However, the growth forecast for this year indicates a softer expansion than we previously anticipated, as we've again lowered outlook for Russia. And that's due to, again, the country feeling the effects of Western sanctions, as well as the effect of tight monetary policy and restrictive credit conditions. The Russian bank is also increasingly focusing on defense spending this year. Also, elsewhere, residential weakness is expected to persist in some markets. Fiscal consolidation measures, election uncertainty will also act as headwinds for the industry overall this year. Having said all of that, EU recovery funds will remain supportive, as well as reconstruction efforts in Ukraine, which should provide a stream of work in the near term. Central banks in the region have also begun monetary easing, and with this expected to continue and also widely across the Eastern Europe region, we do expect this to stimulate demand and activity in many markets this year and also in 2025. In terms of activity spending at a segment level, all sectors are expected to see continued growth. Residential, however, will report the weakest expansion this year, again, due to weakness lingering in some markets like Romania and Hungary, which will see continued decline in residential construction spending this year due to sharp declines in building permits as well as elevated construction costs. In the non-res segments of construction, activity will be supported by EU recovery funds as well. Political uncertainty may act as a headwind, as well as delays cannot be ruled out, especially in terms of EU recovery funds. Poland and Hungary, however, should benefit from some of the disbursements from the EU. Some of the key themes to watch in 2024, I've already covered some. The first two policy rate cuts are expected across Western Europe from mid-2024. This should help stimulate a recovery in investor appetite as well as activity later on this year, but more so in 2025. In Eastern Europe, central banks of Poland, Hungary, and Czechia have already begun monetary easing the second half of last year, and further rate cuts are expected across the region in the first half of this year as other countries also join in. This should support activity levels throughout the year. This year, we're also expected to see major elections happen in the European Parliament, also in the UK as well, and this is likely to create additional uncertainty for the construction industry. Investors may move to the sidelines, holding off any investment or spending decisions, which will weigh on growth prospects overall for this year. House prices are expected to decline further in Western Europe. Looking at the latest data, house prices in the Eurozone declined for a second consecutive quarter in annual terms in the third quarter of last year. Given low transaction volumes, weak lending, mortgage lending activity, S&P Global Market Intelligence expects further declines going forward with a peak to trough decline of around 4% by the end of this year. In the UK, house prices have also been on a downward trend, and we expect further declines going forward of around 10% from peak to trough. This should overall weigh on investment prospects in the residential segment across Western Europe. Finally, energy efficiency has been a focus of the past year and will continue to do so in the near term. I will now hand it over to Jeannine for North America.
Thank you, Amandeep. So I'm actually going to start with Latin America, South America, and some of the key themes that we're looking at for this region for 2024. The first one is going to focus on slower economic growth across the region. According to our global economics team, it's assumed that the post-pandemic recovery in the region is over. Coming out of the pandemic, this region had some very strong growth, and this is now going to taper off to a more trend pattern. The region is also going to be impacted by slower global growth. Tighter financial conditions are causing weakness. You're going to see the slowing in some of the key export markets for this region, including mainland China, the United States, and also Europe. This is going to have this impact on exports, which will then have a follow-on impact to the countries and their export revenues. This slower growth is also going to have an impact on construction activity, particularly on the public side. Another factor in this too, coming in this slower economic growth, is declining prices for some of the natural resources that are exported out of South America, including copper and food products. These declining prices on this side are also going to have an impact on revenues, what's coming in, and honestly, what can be spent and put out for different programs. Another factor that's going to affect economic growth is also El Nino. It's going to have some impacts in the Latin America region. There's going to be flooding, droughts. This is going to have far-ranging impacts across the region. And one area is the potential for increased inflation coming off of that. Now, a second key theme for this region is going to be lower inflation, with the headwind of El Nino potentially causing rates to increase again. But the Latin America region was one of the first to start monetary easing and rate cutting. We expect that to continue into 2024. We expect these rate declines to benefit consumer and business confidence. We expect that this will start to provide a boost to investment. Again, there is a headwind related to El Nino, but we don't think that it will have an impact in the sense of making this inflation go too much higher. If anything, it might slow the rate of decline. And then the final big theme I think that we're looking at here is this energy transition and supply chain area. The Latin America region is key for some mining, renewables, and hydrocarbons, particularly lithium. These critical minerals are being sought, and some of the investors in these areas and some of the buyers of these minerals are mainland China, the US, the European Union. There's a lot of interest in this area, and we expect to see some activity in this. There's also a benefit to several markets in this region, including Chile and Peru, Mexico as well, but we'll talk Mexico when we talk North America. But in the US, they have the Inflation Reduction Act, and one of the components of that with critical minerals and mining was markets that have free trade agreements with the US can benefit from that legislation. So those markets, Chile and Peru, should see some pickup in activity related to that as well. I do want to take a few moments to talk about Argentina. This is the only market in the region that for 5-year growth is going to see declines. This market is in a recession. They just recently had a new president come in with an economy that has significant macroeconomic imbalances, liquidity constraints, debt issues. This president has a plan of a lot of corrective actions, not certain on how long it's going to take to get them implemented or what the overall impacts in Argentina would be. This is the one market in South America that we don't expect to see any inflationary relief in 2024. We do expect that inflation in Argentina is going to remain at triple-digit levels for the coming year. Construction spending in this market is going to be tight, particularly on public investment, as the new president works to make large fiscal cuts to get some of the debt issues under control. So Argentina is going to be the outlier market for this region for 2024, and probably going a little bit further ahead in probably 25 as well. Overall, for the region, this is just the next couple of years outlook. We do see that 24, there is a bounce back. It's not strong, but it does get stronger in 2025. And this is just going to come as pressures recede and overall global growth starts to strengthen, which is what we're expecting in 2025. Moving to North America, these themes all kind of tie together for North America. But one of the key themes is the easing of interest rates. This should push a moderate slowing of inflation, and it should also help, particularly with the residential markets across the board. The United States, we're expecting residential to kind of level out in the coming year as rates come down. Demand should start to pick up. In the United States, the residential market is going to be a mix. We're going to start to see a strengthening of single family, but a weakening of multifamily, which has been overbuilt in recent years. So we do expect there to be that switch of growth, which will lead to overall more muted growth rates. In Canada, they're dealing with higher housing costs, weaker renovation spending. Just essentially, we do expect the residential market in Canada to remain weak to begin 2024. Looking at infrastructure, infrastructure and non-residential structures across the region are kind of tied. In the United States, we see that funds from the Infrastructure Investment and Jobs Act are going to continue to drive growth. You're going to see quite a bit of spending in roads, power, transportation. We expect this to get stronger in 2024, 2025. We do expect peak spending from this Infrastructure Act to occur in the 2024 to 2026 timeframe. And again, some of the most easily direct benefits are going to roads, and there'll be power transportation. We're also seeing a big boost to infrastructure spending in Mexico. We revised up our numbers for Mexico for 2023, and we expect that to carry over into 2024, particularly as there are elections mid-year in Mexico. And the expectation is that these funds are going to be pushed very aggressively in the first half of 2024 to get public investment taken care of before there is an election and potentially a new administration. And then non-residential structures, again, the manufacturing side is a big one. The United States, we've seen close to a 200% year-to-date increase in the computer electronic manufacturing segment. This is the segment that has your EV battery plants, your solar panels, your semiconductors. That has had a huge boost from this. We do expect it to moderate in 2024, 2025 in the sense that spending has kind of hit that peak. Now it's going to level off. Everyone's going to kind of take a breath, regroup, and then see what else is needed going forward. And I did mention the Inflation Reduction Act. There's a lot going on with manufacturing and renewables, and this is going to have an impact across the region as well. Another factor that's having a big role in North and South America is nearshoring activity coming back to Mexico, particularly, a lot of activity coming back to the United States. We do expect this to continue for several more years, and this is being helped by all of this legislation that's happening, producers and suppliers wanting to get closer to the markets that they are serving. So we do expect nearshoring activity in Mexico to pick up, and we do expect activity in the US to continue for a bit longer. Commercial, I do want to touch on this one. Through November, office spending in the US on a nominal basis is up 7%. Inflationary pressures have brought that down quite a bit in terms of real spending. But moving forward, we do expect a lot of moderation in this segment. We're starting to hear anecdotal evidence from companies that they're going to scale back investment in this area in the United States because return to office has not been as strong as expected. So there's some pushback in terms of office construction. There's a lot of conversions going on with vacant space. And I think the office market is still in limbo in terms of return to work and what companies are going to need going forward. For North America, residential is going to be weaker for the next 2 years. The dip in structures in North America in 2025 is just driven by this moderation in growth after strong growth in 23 and then leveling off in 24. And infrastructure, this has to do with some of this peak spending coming. I have a feeling that this 2025 rate for infrastructure will likely come up a little bit in future forecasts. And that actually brings us to the end of our time today.
Thank you for listening to the Economics and Country Risk podcast. Connect with us on LinkedIn and Twitter, and don't forget to subscribe to the podcast so you never miss an episode.